Good afternoon, everyone. My name is Scott Friede. I'm the Division Director for InsureBank, and welcome to the Reagan webinar on the State of the Union for your industry. I'd like to thank everyone for joining us today, and we know you'll walk away with some valuable insights. A few housekeeping items. This webinar is being recorded, so please enter your questions in the Q&A or chat function below, and we'll answer them at the end of the webinar. InsureBank is a proud sponsor of the Best Practices Study, and we've had a long relationship with Reagan Consulting. On the webinar today, we also have David Trauka, InsureBank's President and CEO. Leading our discussion today is Mark Kreitz. Mark joined Reagan Consulting in 2017, and he is a partner with the firm. Mark primarily works with clients on mergers and acquisitions, agency valuation, and strategic consulting projects, and is a certified valuation analyst. With that said, Mark, take it away.
Thank you, Scott. Thank you for being here today, everyone. We know webinars are efficient, but also they do take some time. So thank you for spending just an hour with us. What we're going to do is I have some slides prepared, but what I'd love to do is have you guys ask any questions you have along the way. And I think there's a chat function, so I'll see those questions as they come in. And to the extent I can answer them on the spot, great. But we'll probably reserve some time for the end for maybe 10 minutes to just hit on some of the questions that you guys have. What I'm going to share today is really a look at what's happening in the industry, the insurance distribution space. And for those of you that don't know Reagan, we do have conducted the best practices study with great sponsors like InsureBank for about 30 years. And a lot of the statistics and benchmarking we do will be in this presentation, along with some other benchmarking we do as well. But I wanted to really start off our time today. There's been a lot of news and just things happening macroeconomically in the market over the last several months. And I wanted to maybe start with a statement. And I'll try to reinforce maybe why we think at Reagan this is true. But gosh, there's been consolidation that's probably been happening since the Great Recession in a real material way. A lot of that been being driven by private equity firms that have invested in our space, and a lot of that's not a bad thing, but it is certainly distracting, and a lot is happening around consolidation. We've had technological advances, artificial intelligence, and insurtech come and go in certain circumstances, but now reemerge as maybe an opportunity for independents to grab a hold of technology changes. And then tariffs in 2025 with President Trump. And what I'd like to maybe encourage you guys with today is that even in the midst of all that, a lot of industries are in a much tougher position than we are in insurance distribution. And that's because of a lot of the factors I'll talk about today. But we think that regardless of what may hit us, another black swan event that may come along like COVID or the Great Recession at some point in our future, this is an amazing industry that is strong, and the independent broker, all of you on the phone today, are perhaps more valuable than you've ever been, given all the things that are happening in the industry. And so let me dive in. What I'd like to do is talk about kind of why our industry is so powerful and some statistics to back it up. And then I'm going to walk through 5 key industry trends that we're seeing today. And so, like I mentioned to start, we do a ton of benchmarking. And one of the benchmarking things that we do is what we call the Growth and Profitability Survey. It's free to participate. It's every quarter. Many of you may participate in that survey, but this is data, which is a little bit more real time than our annual best practices study that InsureBank sponsors. But this is a quarterly look at organic growth and profitability for the industry. There's about 200 firms that submit their data every quarter. And this is basically median or average statistics from that survey. So this blue bar is, when we think about organic growth, we think about your true commission and fee revenue, client income, no contingencies or overrides or profit sharing checks as a part of this. This is really how fast your book of business has grown from one year to the next or one quarter to the next. And this is really the truest measure of how healthy and vibrant your sales culture is. And I'll talk about another statistic, sales velocity, in a few minutes. But this is just a trend line you see in Q2 of 20. I wanted to start there because that's when COVID hit. and on March, I think March 11th of 2020, Q2 was really the first impacts that we had as an industry from a global pandemic. And the stock market fell off a cliff. A lot of industries really, really suffered. The insurance brokerage industry said, hey, you know what? We're okay. While we can't sell in person, we may have to sell over the phone in this type of format. The average broker grew still 4 to 4.5% during 2020. And then as the hard market that we've been in for some time now kind of started to accelerate in 21, 22, and we're still in it today, we've seen some of the best growth our industry has ever seen amidst inflation, amidst price increases, economic uncertainty, two elections, and now tariffs. And you see, we have Q1 data out that came out last week or a couple weeks ago, and we are starting to see some softening. But gosh, if you just look at some of the consistency you see quarter over quarter, a lot of that's driven by our industry with the great fundamentals that people need insurance, and you guys provide a great service to the economy. And so this line at the top, consistent organic growth, which leads to what we call EBITDA margin, earnings before interest, taxes, depreciation, and amortization, really your profit that you can deliver to your shareholders. And we think about that as a percentage of your revenue that you receive, commission and contingents and profit sharing as a part of that. But that line represents a very consistent story here, growth all the way through. And then you had a pop in margins over the last few years just based on COVID expense savings, not as much travel while some of that's returning, but a lot of that's driven by higher revenues, higher profitability. But the case being here is we've seen a lot of changes in the world, in the economy over the last, in this case, 5 years, and really not a lot of change in the brokerage universe. Very consistent growth, and in some cases, some of the best growth we've ever seen. And so I want to just, I should have put this up earlier, global pandemic, inflation, tariffs. We've grown through all that. And so just with that as a backdrop, what I wanted to talk about is really 5 things. And 5 things that are happening that are probably either causing opportunity for your firm, discomfort or concern in some ways, but in a lot of cases, big opportunity. And if you think about the theme, and we have a hard time not talking about consolidation on these, although people may be tired of hearing about it, and I don't blame you. But gosh, we have been in an industry that has been evolving really rapidly over the last 15 years, and a lot of that's been driven by some of the largest firms in the industry. And we refer, if you guys are familiar with the Business Insurance Top 100 listing that comes out every July or August, and it basically charts based on revenue in the U.S. the largest insurance brokers in the country based on the prior year revenue. And these are the firms in 2024 that had over $1 billion in revenue. And I'll show you some other stats about what this looked like 10 or 20 years ago, because it's been an amazing change. But just this group is responsible for a ton of that consolidation activity. And a lot of these firms you see on the screen didn't even exist 15 years ago. Pretty remarkable. And there will be more logos on this Billionaires Club list in 2025 and 2026. But some of these firms are not actually part of the Billionaires Club anymore. They are now part of a larger, or maybe going to be part of a larger organization, NFP Truist, which is the McGriff retail flagship in the Southeast, and then Assured Partners, which is still being in kind of regulatory approval with the Arthur J. Gallagher. But you have, even without these three, $17 billion brokers in the U.S. today, creating massive scale in the industry that are, in a lot of cases, Marsh and Aon may not be competing with you guys or Willis, but some of these other firms may be, because they've acquired firms in the middle market. And so how does that change your dynamics in your market today? Does that give you opportunity because they're not paying attention to the smaller clients? Or does that give you heartburn because you now have to compete with a global gorilla? And just over the last year, we've seen 3 of the largest transactions in our industry has ever seen. And I just mentioned these 3 on the last page, but The three largest public brokers in the country, Aon, Marsh, and Gallagher, have been basically the ones that have been able to purchase and almost purchase. Assured Partners and Gallagher are still in regulatory kind of approval status right now with the FTC, but NFP and McGriff are done. And those both closed last year in April and in November. And if you look across, the average deal size here was roughly $9-10 billion. And so this represents revenues. NFP was about 3-4 billion, $3 billion. McGriff was about 1.3, and then Assured Partners was about 3 billion. And so over those three firms, you have $7 billion in revenue that is now part of larger publicly traded organizations. Again, some in McGriff, Assured Partners, and NFP all have middle market focuses, of which the same, your group does, this group of agencies does as well. And I'll come back to that later. But these mega deals, we think, will probably continue, because the exit strategy opportunities for firms that get to this size, public offering, a larger private equity firm, of which once you get to $2 or $3 billion, those may not exist in plentiful. There's just not that many large private equity firms that can bite off those big chunks of $10-13 billion valuations. That's just too high. And so either a public offering or a strategic sale becomes the most likely outcome. And thus you saw three just potentially over the course of a year. We think that'll continue. And so I wanted to show you guys an illustration of what this has looked like over time. I mentioned $17 billion brokers that exist today. And so how has this business insurance listing really changed over the course of, let's just say, the last 20 years? Well, in 2004, the 100th largest firm in the industry in the US did $20 million in annual revenue. Again, revenue, contingencies included in that, profit sharing included in that. Most of that is commission and fee income, but $20 million of revenue for the 100th largest firm. The 10th largest firm did about $290 million in revenue. Okay. 10 years later, 2014, that $20 million firm, that 100th largest firm, is now $24 million. All right. Probably similar firm, just a little bit of growth. But the 10th largest firm is now $770 million. Almost a tripling, 2.5 times. And then last year, in 2024, the 10th largest firm grew to $2.7 billion. And the 100th largest firm is basically the same firm. It's $31 million in revenue over 20 years. That firm has not really changed all that much. But the top of the industry, Marsh being the leader of that, that's been the change. The consolidation activity has really been driven at the top. Publicly traded firms, private equity-backed brokers that have used outside capital and private equity capital, outside debt capital to fund acquisitions. And a lot of you on the phone have probably done acquisitions. A lot of these firms maybe doing 30 deals a year, 50 deals a year, in some cases 100 deals a year for a lot of these larger firms. And is that sustainable? Not for everybody. But gosh, there's been an incredible run of activity, and a part of that is driven by the valuation environment that I'll talk about in a second. But that leads us to we had $4 billion brokers in 2004. Now we have 17 of those, and really that change has been driven through M&A over the last 15 years, and we think that may continue. And so what's this ultimately going to mean, kind of maybe 5 years from now? Reagan thinks that there's probably going to be another 6, 7, 8 firms that join the $1 billion club. So we think there'll probably be $25 billion firms in the industry in the US 5 years from now. There'll be 40 firms or more over 500 million. So that rounds up the top 50. And an industry where the 10th largest firm is now over 35 times the 50th largest firm. And so you think about the 10th largest firm in the industry, which is probably $2 billion, is 35 times larger than the 50th largest firm and maybe 100 times larger than the 100th largest firm. And this all means that privately held brokers, all of you, will have to stay competitive, focusing on things that I'll talk about today: specialization, culture, equity opportunities for your employees, being selective in your hiring, but also being aggressive in your hiring, and then technology as well. And I'm going to talk about each of these things to some extent today. But that's what's happening at the top, and a lot of that being driven by M&A. And a lot of these firms, while Marsh, Aon, and Gallagher, and perhaps Willis, Gallagher may be aside, but Aon, Willis, and Marsh in particular, historically has not really focused on the middle market. But a lot of these firms that are being built right now are focused on the middle market in direct competition, in some cases with the independents. And that means the competition is changing, and in some cases providing opportunity, in some cases providing challenges, because they may access resources that you can't access right now as an independent. But there are ways to combat that. So that was trend number one. Trend number two is that we have seen, I showed you this chart earlier of organic growth. And organic growth, I'll maybe define that a little bit more clearly. If you do an acquisition, or if you, again, contingencies, those are excluded. But if you do an acquisition in a year or divest a book of business, we account for those things. So really what we're focused on is what you have as a base last year. And then in the next year, what did that base grow to or shrink to? And that is really what we're focused on. And so this growth that we've enjoyed over the last several years has really been aided by that hard market. And this is data from that same survey, going back a little bit longer, going back to 2009. We started our quarterly survey in 2008. And you can see over a 16-year run, we've had 1 year of organic growth less than 0%. So in 2009, when the economy cratered, the real estate industry cratered maybe 30, 40%, the stock market cratered, same amount. Our client base, the independent insurance distribution system, shrunk 2%. Pretty remarkable. And then it went positive immediately the next year. And since that time, we've had our industry for 20 or 30 years. I think Scott and team would probably see this as well, that it's been about a 4 to 6% average growth industry for forever. And not until recently have we seen growth like we've enjoyed since 2021. In 2021, the hard market really started hitting, and up until that point, up until 17, it was soft, but it took the industry a little bit of time to harden. A lot of that was property driven. A lot of that was early on D&O and professional lines driven. Property is starting to soften now based on our conversations with clients. Auto liability is not. That may be still going up. Same with GL lines. So you have different forces pulling things different directions. But in this last 4 years, the average broker has delivered 8 to 10% growth, which is remarkable for an industry that forever has averaged 4 to 6%, call it 5% being our industry average over a 20 or 30 year period. And so if you're thinking about how are we doing, that's a good measuring stick. Is over the last 3 or 4 years, 10% has kind of been where a lot of the industry has been. And in this year, the first quarter of 25, we are starting to see early signs of softening. The commercial lines of the group that submits data to this survey is heavier commercial. And so whatever your firm is, this is probably, if you look at the median revenue mix from the groups in this survey, it's probably 60% commercial lines, 20% benefits, and 20% personal lines. So a diversified firm, but heavy commercial. And so commercial, when that swings, as does, so does the growth, but commercial really has been driving a lot of this growth for a long time. And a lot of that was driven by, again, this is just an illustration of that hard market. So we had a hard market from 11 to 14. We had softening rates from 14 to 17. And then we are now in the 29th straight quarter of rate increases. And this is from the Council of Insurance Agents and Brokers that does this every quarter. But gosh, you see this huge spike in late 20 or early 21, kind of on the heels of COVID kind of coming back, the economy getting pumped up, but you had this huge spike, a lot of that driven by inflation. And see, one of the great things about our industry is inflation goes up, premiums go up as well, commissions go up as a result, and you guys ultimately benefit. While it hurts the wallet from a consumer basis, the insurance industry actually doesn't get hurt too much because we follow a lot of those inflationary trends. While the softening has the same result, but in this case, over the last 7 years, we've had almost 30 quarters of straight premium increases. And every market's different, every geography is different. Florida looks very different than New York, which looks different than California and Texas. But gosh, we've had an incredible run of, as long as you can retain the business that you have, and I'm sure you have to go to market more, you have to go market your business to different carriers a lot more than maybe you did because you're having to deliver 10, 20, 30% increases to your clients, which hurts and it's painful. And no kidding there. But if you're able to retain it and you do a good job for your client, that revenue comes to the independent insurance agent, which is fantastic. But this is really what's been driving a lot of that growth lately. And so the question is, where are rates headed now? Based on what we hear in the property market, that's softening a little bit. But will recent natural disasters ultimately keep those rates maybe at 5-6% on the positive overall? Time will tell, but that may keep rates up for a little bit. And I mentioned the revenue mix of the typical agency in our survey. I wanted to show you a little bit of there'll be a few lines here, so don't get lost on the craziness of this slide, but this is the commercial lines organic growth from 2014 to 2025. A dip during the soft market, a jump up into COVID, a dip during the COVID area, and then just a huge acceleration when the hard market popped, like you saw on the last slide. And so that has kind of normalized back to 8% now in 2025. And then you have personal lines. Personal lines forever has been the lowest grower, but the highest profit margin. Personal lines, lower touch, more clients, way more policies, but generally easier to service because you have lower touch, less complications in home and auto than you do in property and umbrella and other, business insurance. Until really 2023, when personal lines got a shot in the arm and you had this almost 10-point swing in 2 years where personal lines now is the leader in the clubhouse from a growth perspective. If you're a heavy personal lines firm, hopefully you've been able to enjoy, as long as the retention is strong, really strong growth the last couple of years. Because again, the hardening of rates on the auto and home side has really been powerful over the last really 6 to 12 months. And a lot of that's been driven. And you can see here that personal lines is now leading the charge from an organic growth perspective. The green line is benefits. Benefits are a little bit more choppy, and you see a little bit of a dip here in COVID in 2020 and 21. What we heard really from clients around the country was we had benefits firms that were active in trying to sell new business. All of their prospects said, you know what, during COVID, my employees have been through enough. Thanks, but no thanks. I'm not changing right now. Call me back next year. So you had a little bit of a new business pullback. And that opportunity was really strong just by the pandemic and changes to people didn't want employees to have more changes than they already had. And so that has now reemerged, and you've seen benefits make a little bit of a comeback, and now is up to 7.5% over the last couple of years. And so you basically have these converging of lines of insurance. The three main lines, commercial, personal, and employee benefits, are all delivering really solid returns right now. And the average being, as you saw on the last page, 7.9%. Is the average organic growth for the industry that we saw in the first quarter of this year. And who knows where these lines go, but right now you have each of those delivering really solid returns for your business. I mentioned sales velocity a little bit earlier. Sales velocity is a metric that Reagan developed a number of years ago, and it's really a measure of new business, what we call broker horsepower, because you can see how much of an impact that pricing changes have on the industry. And if we can't control that as an industry, if you think about there are four growth levers. One is new business creation. Two is retention. Three is exposure and ultimate, kind of exposure base of the risk that you're underwriting and selling. And then three is pricing. Exposure and pricing, that's kind of, we have no real control over that. That's set by the reinsurance markets, et cetera, and what's going on in the economy. But we can't control retention and we can't control new business. And so how do we, Reagan, assess as a part of our valuation practice, or how to assess, the healthy state of a broker, is really this metric called sales velocity. And so if you're, let's just call you a $5 million revenue agency in 2024, and think about, just take contingencies and profit sharing out for a second, $5 million in commission revenue. And you write $500,000 in new business in 2025. That would deliver a sales velocity of 10%, 500 over 5 million. And the industry for a long time has been basically a 10 to 12% industry. And so if you're a $5 million commission revenue firm, you write $500,000 in new business the next year, 10% sales velocity, you'd be slightly less than kind of the midpoint in the industry. The average was 11.9% in 2024, which means that firm did about $600,000 in annual revenue. I'm sorry, in new business revenue in 2025 versus a $5 million base. The top quartile did 17% sales velocity, bottom quartile 8%. But the point of showing you this is, since we can control new business and retention, but focused on new business for a second, if we take the top quartile sales velocity, that is directly correlated to organic growth. It's simple, but the more new business you write, generally the faster growing your firm is going to be on the organic side. Blue bar is sales velocity, green bar is organic growth. Organic growth is generally going to be lower than sales velocity. Sales velocity is just a measure of new business, but the organic growth includes all four of those levers: exposure base, rate changes, new business, and retention. And so you're going to have lost business pulling back on that, retention back, pull back on that. But pricing may ultimately help that. And we've had the sales velocity and organic growth bars be a lot closer than they historically have been because of that hard market, because the rate is pushing up that organic growth. But if you guys control the sales velocity and think about 12% as your bogey, that's the midpoint of the industry. That's what you want to focus on. But if you do 15, 20%, we have firms that do 30 or 40% new business annually. As long as you're controlling the retention and any leakage that goes out the back door, you're going to deliver outsized returns for your shareholders from an organic growth perspective. But since we can only control two things, those are the two things we should focus on. One of the most important being new business. But this is really what's going to separate over the next, let's just say 5 years, as we may have a soft market in a few years, don't know. But if we do, the firms that are maintaining high new business figures and higher sales velocity are not going to have this huge dip down in growth. They're going to be able to level out and ultimately continue to deliver strong returns. Easier said than done, no doubt. But this is a good metric that you should always focus on as you think about each quarter, each year, how you're compared against the industry from a new business perspective. Trend number 3. So I talked about consolidation, and yes, that is impacting both positively and negatively a lot of you on the phone today. But as a part of that consolidation, we think at Reagan that there's going to be an incredible opportunity for the independent firm to recruit some people in the industry that may have been displaced through acquisitions. And while we are a part of a lot of those, you never know, like there may be one or two people in every situation, whether it's the best thing in the world for that firm or not, that may not feel like they've landed in the best place. And I want to just a quick picture of maybe why this may be important to the independent firm. We're college football fans down here in the Southeast, and we think this is a kind of a powerful illustration that the two quarterbacks in this year's college football national championship were transfers. They didn't start at Notre Dame. Riley Leonard started at Duke, transferred to Notre Dame. Will Howard started at Kansas State, transferred to Ohio State, won the national championship But that's what's happening in our industry right now. You think about the NIL and sport and college athletics, that's what's happening in our industry right now. And a lot of, you may see, unfortunately, litigation, every week in our industry right now because of this producer mobility that's happening. People are transitioning their business and, in some cases violating restricted covenants. And that's certainly never what we would ultimately recommend for anybody. But there's going to be an opportunity for individual firms, in particular independent firms that have an equity story to tell and an opportunity for a producer that's been displaced as a part of consolidation to find a new home. And so, like, what's led to this point? Well, we have, many of you may have heard of the great resignation that people called it after COVID, when the statistic that I heard was about 78 million people left their job from 21 to 23 voluntarily, which meant early retirement. They wanted to go fully remote. Their employer said no, and they just said, you know what, I'm good. I'll go work for somebody else, or just left the workforce because, at that point in time, the government was ultimately, with PPP money, et cetera, was ultimately helping people that had a hard time during the pandemic. But that kind of started this mobility mindset, and that is now kind of translated into what our industry is going through right now. And so that great resignation from 2021 to 2023 was the start. And then you got this, what we call producer lift outs. And so all we mean by a producer lift out is when an experienced producer or producers, a team of producers with a book of business, is lifted out, leaves to go to another firm, generally a competing firm or another firm in the industry, whether it's in the same geography or new geography, doesn't matter. Same concept. You're lifting a team or a single person out of a firm into another firm. And there are ways to do that the right way, where there's no violation of restricted covenants. You abide by the law and you let that person sit out for a couple of years, and then they can go after the business fully, totally fine. But that, what we call the valuation advantage for lift outs, is if you buy an agency, and I'll show you some multiples here in a second, it's expensive. And it's gotten more expensive as the private equity investor base has really got into our industry in a material way, and they've changed the game. The public brokers have also led the way because their performance has been strong, the industry has been strong fundamentally. And so if you do a lift out of a person or a team versus a whole agency, there's some arbitrage there from a multiple perspective where you can actually buy that revenue base for less than you may buy for an agency. Coupled with now significant consolidation that's really gone on since 2010, really since Hub and USI went public to private, and the private equity universe saw, yeah, I want to do that too. Really successful M&A stories, Marsh McLennan Agency that was birthed by Dave Eslick that now is, bigger than Marsh Agency, or not Marsh Agency, Big Marsh Retail. Marsh Agency is bigger than Big Marsh Retail in the U.S. now. A lot of that's been driven just by pure M&A. And so now we've got those three things that have added up to what we call, kind of like the NIL in college athletics, the free agency era. And we'll talk about how privately held brokers, independent brokers, respond and capitalize on that. But we think there's going to be a lot of people, producers, service team members, that are now working for somebody that they didn't have in mind, that will, who better than an independent firm to ultimately capture those individuals. Now you have to sell them on the opportunity, and a lot of that may be, hey, the equity opportunities there. It's more tangible. It's a smaller firm. I can control it more. These are industry veterans that may not need all the market access, just need some markets that can go write new business and believe in themselves. But it's a bet on themselves to leave a big firm to join an independent. But that's our job to convince them that that's a great opportunity, because we think there's a lot of people out there like that you guys on the phone can capitalize on over the next 5 years. Okay, trend number 4. And so why is all this consolidation actually happening? Well, valuations have a lot to do with it. If you can sell your business for a large number, then people look around like, I want to do that, and I take care of myself, I take care of my family. It makes a lot of sense for sure. The ultimate consequences, good and bad, are you got to work for somebody else, and so there are pros and cons to independence and also selling your firm. But the point of this fourth trend is really, why are people selling? Like what's actually been driving this, and what's underpinning the interest in the sales that are happening in the industry. It is all kind of, if you kind of go through all the performance has been strong, et cetera, et cetera. Why have so many investors flocked to our industry over time? You know, it is, you get to retain what, 90% or more of your clients every year. If you're really bad, maybe it's 85% or 80%. Pretty good. There's no capital expenditure requirements. Working capital only takes about a month to kind of, for cash to generate itself based on carriers and clients paying you commissions. And it's pretty sticky. It's based on relationships. And so it is the poster child for a private equity firm, especially a private equity firm that wants to put a lot of debt leverage on it. It's a very cash flow heavy asset. It's a great business. Pat Gallagher has said in every earnings call, I think forever, this is the greatest industry in the world. And we believe that. But what's led to these valuations is those public brokers. And I'm going to just show you some statistics here. So publicly held brokers, and I'm going to focus on the top five. I don't have Baldwin on here. I don't have Goosehead on here. I don't have the Woodlands or even Ryan Specialty, the newest, or one of the newest wholesale insurance brokers that is now publicly traded. But Willis, Marsh, Brown and Brown, Aon, and Gallagher have been kind of the mainstays over the past couple decades that have been publicly traded. The dark blue bar on this left side of the page here represents the multiple of earnings, or EBITDA, that I mentioned earlier, basically your pre-tax profit that their firm is valued at. And so you probably have heard of multiples in the industry when people sell their business. This is that multiple. This is how they trade right now in the public markets that investors are buying and selling every day. But the dark blue bar represents their multiple, their value multiple in 2015. The light blue bar represents 2024. So you look about the average in 2015 was roughly 12 times EBITDA. Healthy number. It was 12 times for probably 10 years before that too. Not a lot had changed. In 24, 9 years later, that average is 15.3 times. So basically a 25% increase over the course of 9 years. That's a big deal. And that's a big deal because if you think about consolidation, and if you think about Arthur J. Gallagher paying for Assured Partners, if they can buy Assured Partners for a multiple of less than, in their case on the bottom here, 19.3 times, that by definition is accretive and positive to their shareholder base. So if they can buy Assured Partners for whatever it was, 18 times, 16 times, 15 times, and they're valued at 19.3 times, that's an accretive deal. And to help you guys maybe put this in maybe a little bit simpler terms, because EBITDA can get a little kind of messy as you think about it. But the point here being, there's been an incredible run of really strong performance, more investors being interested in the space, success stories everywhere in our industry, private equity backed, publicly traded, independents doing really well, that has led to really strong valuations. And oh, by the way, while it's not recession proof, it's pretty resistant to recessionary trends, especially relative to other industries. So that was a multiple of EBITDA. On the right side, you have a multiple of revenue. And so the average multiple of revenue, the same value for these firms, but just as a multiple of revenue, in 2015 was roughly 3 times. In 2024, it's now 5.4 times. So that increase is more drastic than the EBITDA change, because the profitability of these firms, many of you probably have seen the profitability rise, and COVID maybe has changed that a little bit in your favor as well. But the profitability of these firms has gone from about mid-20s margin, 25% of revenue was the average margin in 2015. Now that represents 31%. So you've gone from 25% margin to a 30+% margin in about 9 years. That's a huge, huge, huge jump. And so when you have good top line performance, economies of scale on margin improvement, you get massive valuations. And so when you have high valuations, you can deliver high valuations for sellers, which then brings more sellers into the market because they get to, reap the benefit of what they built over a long period of time and cash in as a part of these valuations. But the publicly traded brokers have really led the charge. And if you think about the Hubs of the world, the USIs of the world, all of the Alera groups, the Patriots, all of those firms, Hilbs, discount their values to the publicly traded firms. And so if Gallagher, if the median multiple here is about 15 times, you may have brokers that ultimately trade for 14 times or even 15 times, and to some degree 16 times. We've heard as well. But if they're valued there, they can buy stuff for 12, 13, 14 as well. And so when you have this confluence of really strong performance, good investor appetite, strong stock performance, it leads to a really healthy picture for our industry. And actually, a lot of these investors, I mean, while it may be distracting and this M&A is kind of wild, we think it ultimately leads to a vote of confidence that our industry has, that the investor base loves it, which is why we think, and this proves it right here. These are the values that for a firm that's between 3 million in revenue to $10 million in revenue of what we see in the marketplace, the deals that we're involved with. You used to, if you sold your agency in 2011 and you're between this is a good quality firm, growing firm that's invested in the next generation, $3 to $10 million in annual revenue. You sold your business for, at closing, 6.3 times EBITDA. This is EBITDA multiples, profit multiples. And then you had an opportunity after close to get an earnout, what they call an earnout, generally over a 3-year period based on performance. You have to deliver a certain amount of annual growth to hit that. But that green bar represents that earnout opportunity. At closing is the blue bar. And so in 2011, that was 6 times. 2024, that's 12 and a half times. And we think 23 and 24, and really in 22, we haven't seen much of a change. It's been very consistently held because the competition has been really strong, investor appetite has been really strong, performance has been really strong that we've talked about. But the valuations for firms have doubled. No kidding that you've seen a lot of M&A activity. A lot of that's been driven by, again, the public brokers and their performance as well. Last trend. And this starts to get into how you as an independent firm ultimately compete with these larger firms, because in some cases it may be daunting that they have all the resources in the world, AI opportunities, things they're investing in on the technology front that you can't invest in. But what you can control is what you write. And a lot of your businesses may be businesses based in, community areas, community focused businesses. And even in those areas, you can specialize, whether it's geography specialization or industry specialization, or even a line of business like D&O or whatever it may be. The more you can specialize, the more efficient your service team becomes, the more efficient your producers become, and the more opportunities for new business that you ultimately get and enjoy. And what does that lead to? That leads to higher organic growth. And so organic growth, this is from our best practices study for firms that had over 50% of their revenue in what they call specialty verticals, industries, lines of business that they really dedicate their time and attention to, where they attend trade shows and they attend things in the industry where they're a well-known commodity. Those firms outperform, and they've outperformed non-specialized firms forever. And we think this trend will even be more drastic as competition continues to increase as well in the industry. But you can see here, specialized firms generate, almost 34% more organic growth than their peers. And oh, by the way, it delivers on this left side better new business. $188,000 in annual new business was the average commercial lines producer. This is commission revenue for firms over $10 million in revenue. This was the average producer, generated $188,000 in 2024. For a firm that was over 50% specialized, for a less specialized firm, it was 140K. And the books of business that those producers and specialized firms are able to manage is upwards of $1.4 million versus $1.1 million. And again, these are firms over $10 million in revenue. And there are some, if you go down, specialization really starts to manifest itself as you get to maybe 4 or 5 million in revenue, as you can really dedicate some of your time. Because a lot of the path to $5 million in a lot of ways is finding that niche, finding where you really excel and what you're good at and what makes sense for your geography. And then, we here's another metric that we love metrics. So sorry to kill you guys so much with metrics, but we did a study 10 years ago where we basically showed brokers in the industry were not doing enough hiring to ultimately meet their growth goals. And if their growth goal was 5%, we think over half of those brokers weren't doing enough hiring to ultimately meet those goals. And so we developed this metric called what we call NUP, which is the net investment in unvalidated producer payroll, which basically means how much salary or draw that you, as your agency, is floating to that new producer that you hired, somebody that's just getting started in the industry, or somebody that comes from another industry that had sales experience, just a new producer in your firm, how much you're investing in them over and beyond your traditional commission split. And for forever, we were hopeful that this number was going to continue to graduate up. We thought we were doing great in 2018. Over 2%, we think a really high quality number for a NUP is you invest 2+% of your revenue in unvalidated producer payroll, those salaries and draws for new producers. In 2024, we were at 1.6%. But as you grow, obviously that number gets bigger, which means you have to invest more or invest in more high quality people. But if you're not investing in the next generation and those next producers, it gets harder and harder over a long period of time to meet those growth goals. And so 2% is what we would recommend as something to strive towards. Because I think when you think about it, and to boil down the producer value prop, what does a producer really want? Yeah, they want resources. They want to make sure they have the market access, a service team. And for Big Marsh, that means a lot of things. For the independent, it means different things, but probably less. But that's okay. Because as long as you service them well, some of the best service team members that we've ever met are in independent firms, because it's a better culture. And they pay more to producers. The second here being compensation. As an independent firm, you can probably justify paying slightly higher splits. The traditional splits for the insurance brokerage space now for larger firms is 40% new, 25% renewal. If you, as an independent firm, can justify a little bit more because you don't have all the resources known to mankind, that may be attractive for the true hunters out there that really want to grow their book of business and have freedom from the what we call bureaucratic stupidity of just too much red tape. You guys can be nimble. You guys can be quick on your feet and adapt to your environment much more quickly than a larger firm. And then I'd say the key thing is the ability to create meaningful wealth over a long period of time. Is there an equity story in your in your firm that is powerful? Because a lot of what private equity has done really well is they have really shared the wealth with producers in particular, executives, operations leaders, service team members, where they want those employees even to be owners of the business. And that concept in itself is challenging in a family-owned business, and you may not even have that opportunity because you have a different ownership structure. But in the event you do, and there's synthetic equity, there's phantom equity, there's options, there's various ways for you to ultimately provide those golden handcuffs to make sure you keep people in place that you can't afford to lose, but also to attract people from other firms, is that wealth creation opportunity. The greatest talent generally follows equity. And so I want to just breeze through a couple of these things, but I want to come to one slide, which is just to summarize, as you think about where you guys sit today as a privately held firm. The number one way to compete against the larger brokers in the universe, in the industry today, is specialization. Again, that doesn't mean it has to be construction or real estate or technology. That just means it has to be a specialty that really makes sense for your firm, whether it's in your community, whether it's in a certain industry, whether it's a line of business. The ability to specialize and really focus your efforts for your team, because that makes you more efficient, which ultimately increases your profitability because you can be more efficient, but ultimately provides more opportunities and more new business that your firm can enjoy. The second is this concept of team selling. And so as your firm kind of gets bigger and drifts up market, and you're starting to compete with larger firms, that may bring a loss control person, the risk manager, claims person, data analytics, and they bring 7 people to the meeting, and you kind of show up by yourself, and you're like, hey, here's agency ABC. We've been your agent for 20 years. You trust us, we trust you. We'll deliver the best outcome. But then somebody comes in with 7 people, and they can give you all the bells and whistles the more you guys can think about that, it doesn't need to be 7 people, but maybe there's 2 producers that go to a larger, account. Maybe it's two producers and a claims person that you hire because they have some good analytical capabilities. But team selling can ultimately be to your benefit. Collective power, things like this is really what we mean by collective power, meeting with people that have commonly independents, privately held firms that have common goals in mind of growing their firms and being successful, but having a firm like InsurBank or a Reagan or a aggregator, a network that ultimately can deliver to you some additional synergies on contingencies and profit sharing, is powerful and can be powerful. Engaging in technology, you may not have all the resources possible to invest in a data engineer, an analytics person, AI, but we know there'll be things that you can rent off the shelf. But just make sure you're monitoring technology to the extent policy checking can be offshored, to the extent you guys can do things more efficiently, where your account managers, account executives, and producers can take a little bit more of those things off their plates to make yourselves more efficient. Engaging in that, I think, will be important, especially over the next 10 years. Leveraging best practices, making sure hey, if my sales velocity was 8%, oh, okay, now that I know it's 12% was the median, making sure you're really monitoring the industry and how people are performing and how you guys stack up. If you're not measuring data, you're not able to manage it that effectively. And then relationships, this is still a relationship business. It'll always be a relationship business. But as you have clients get bigger and demand more, how far will that relationship go? Making sure relationship is where you lead first by sprinkling all these other things that I mentioned into the equation as well is really important. So that's what I wanted to share today. And I wanted to leave a little bit of time, Scott and Dave, for questions if we had any. But thank you guys for listening.
One question. How are internal perpetuations being trending?
Yeah. I wonder if that's in terms of valuation. So as you thought, I showed the valuation multiples a little bit earlier for when if you sold your business to a strategic firm. Valuation multiples, we do about 80 to 90 valuations a year at Reagan for internally perpetuating firms. And the multiples of earnings, we don't use the multiple to arrive at value, but that just becomes a metric that we use to kind of show value, but it's really based on the future cash flows of the business, things that, Scott and Dave would ultimately do as a part of their analysis when they're underwriting a firm. But those multiples have been trending up as well because the market performance has been good. The market has been good as well, as you saw in my presentation. But I think, on average, those, independent firms that are anywhere from 5 to maybe 20 million in revenue could be trading at 7, 8, or 9 times EBITDA internally, something like that. Because it's based on the future cash flows, and you want to make sure that you ultimately have buyers that are able to make those payments. If InsurBank is the lender in a situation where you're using them for a shareholder loan program, that shareholder has to be able to use the cash flows of the agency to ultimately make sure those note payments are satisfied. And so you have to make sure those cash flows line up with the value. And so it's always going to be a little bit less than what you can sell to Hub because they can add a bunch of synergies on top that will be on their side. But generally trending up 7 to 9 times would probably be the average. Another question, it looks like, when will the top 100 agencies be released? That should be July or August is generally when that comes out from Business Insurance. Another question we got was, what valuations do we see for firms under maybe 2 million or maybe $2 to $3 million in revenue? For a growing firm, that has multiple layers of producers, you know, you may still hit double digits out there, 10, 11 times. It's going to be slightly, there is a size premium as you get bigger. Naturally, a larger agency is invested a lot in those same resources that you have, just on a greater scale, just like the larger firms have as well. But I'd say maybe a 1, 2, 3 times discount to firms maybe that are growing in the $3+ million range, something like that. And then I got one around, how often are you seeing ESOPs for firms over $10 million in revenue? Yeah, good question. We have seen fewer ESOPs come into play over the last 10 years than we did the prior 10 years. And there's some reasons for that. We have a lot of clients that are ESOPs right now where we annually appraise them because the ERISA guidelines asks for an annual appraisal in order for them to make sure participants are treated fairly. But in a lot of ways, it can be a incredibly helpful tax vehicle, incredibly helpful. And for when you initially go into an ESOP, for the current shareholders, it can provide a little bit of a premium valuation to you as a shareholder at that time. The problem, so those are the benefits initially going in. The hard part for ESOPs, once you start to spread your ownership base over time, is everybody has to be kind of treated the same, and you can't rifle shot certain amounts of equity into the people that are really driving the value. And so you have contribution and share ownership that starts to become disproportionate, and that's where those become challenging. And to get out of an ESOP is even more challenging. And so it is an incredible tool for employees. The harder part is just making sure you can really be nimble on what you want to do ultimately over time. But from a tax perspective, it's fantastic. For current shareholders, it's fantastic. Tricky as you want to try to be creative with new opportunities for shareholders down the road. But seeing fewer and fewer of those, just because of you have kind of another shareholder that's participating basically, which is the Department of Labor. All right, one more I think I got, and I know we're almost at time. What's a good or great number for revenue per employee for a best practices agency now? Great question. And I wish I had that on the top of my fingertips, which I can probably get quickly. But, if you look at the publicly traded brokers, they're probably in $250,000 a head in revenue. For the long time, our industry was maybe $200,000 a head. Public brokers, as they get bigger, larger firms kind of have some economies of scale there, which helps with that. But for the best firms we see, it's probably 300 grand and above. But in the 2 to 300 grand segment, you're in a great spot, because some cases, like, you're in a period of heavy investment, and so you haven't caught up yet because you have producers that are validating, and that just takes time. But between 2 and 300,000 is probably a good gut check for revenue per employee. 300,000 being really, really strong. So I don't want you to look at yours and say, "Oh my gosh, that's crazy," because those are firms that are high performers. But as you think about getting to 200 and above, that range is probably a good one to strive for. All right, Maria, I think we are all set on questions. Well, thank you guys for having me, Dave and Scott and Marie. This was fantastic, and I appreciate everyone's time on the phone. Hopefully this was a just good segment into the summer for 2025.
Okay, well, thank you, Mark. Appreciate your time today on the webinar, and thank you everyone for attending.